It's an interesting point to start our conversation then, Sarah, on the day we get inflation data, because, of course, that could underscore the reasons why we're seeing this hammer, this brute force tool being employed by the US central bank. Interest rate rises, of course, and the effects that they are prepared to see on the economy. To what extent do you think this is a Fed that is prepared to see higher unemployment and lower stocks to really focus on their main goal around inflation?
Well, the messaging has been incredibly hawkish. So far, it seems as if inflation is the be-all and end-all. The Fed hasn't indicated clearly yet that they are prepared to tolerate a high level of inflation and weaker growth, but we think that that is the natural outcome. In a sense, they have the firepower currently and the backing to do whatever it takes to tackle inflation. And I think from a policymaker's point of view, it probably does make sense to front load these rate hikes, especially as we are going to be seeing incredibly high inflation. We already have, and then the next couple of months we think are going to stay very high. But we do worry that there is demand destruction in this policy, that we are likely to see a continued squeeze on incomes. Real wages have been declining since last April, and that is going to undoubtedly have a drag on spending. We've seen sentiment already down very, very sharply. So unfortunately, it looks as if achieving the inflation target is going to mean some pain for the economy.
Sarah, good morning. You described this Fed as having been extremely hawkish so far. We've only had one hike. We haven't started QT yet. Do you think that the communication means that the yield move has already been done, or do you think we have much more topside in yields to come in the next coming months?
I mean, we've seen such a sharp move in yields so far, and we do feel that the market may be running ahead of itself in terms of what the Fed will be doing for the year as a whole. So there are some very aggressive rate hikes priced in already for the next few meetings. We'd certainly agree. We're looking for a 50 basis point hike in May, another 50 basis points in June, 25 basis points in July. But we think at that point, there will be clear signs that the economy is slowing down, and there will be clear signs that inflation is moderating. So at that point, we expect the Fed to pause really until the end of the year. So it suggests to us that this run up that we've seen in yields, it may be getting near to the peak, although I'd hesitate to call the peak in the yields given the moves that we've seen over the last few days.
And how does that translate into another asset that has benefited from the rhetoric, the hawkishness around Fed tightening, and that is the dollar, Sarah? Would you expect that the dollar would also peak around the same time?
Yes, I mean, obviously, dollar has been affected by what's been happening in Ukraine, and as long as the situation there remains highly tense and indeed escalates, then we think that the dollar is going to stay supported. But we think that we perhaps are close to the peak there, again, for similar reasons, that if as we hope, the situation in Ukraine at least stabilizes in the coming months. If we're right that inflation is going to be peaking out in this current quarter and that growth is likely to come up through somewhat weaker, to us that suggests that there's a limited further upside for the dollar. We expect the euro to move back up towards the sort of 112 level by the end of the year, 114, and somewhat stronger than we see currently.
You've talked about being concerned around the downside for the US economy, Sarah, even though you acknowledge that inflation is, of course, the focus right now for the central bank. That must be even more stark in the European context. In fact, you expect inflation in the Eurozone to be higher this year than it is in the US. But, of course, war is much more geographically present here in Europe. How tough is the job for the ECB this year?
It's very tough, and I think that the splits are evident in the minutes that we saw last week. You have the hawks clearly concerned about inflation, taking the view that QE needs to come to an end pretty rapidly and that rate hikes need to start very soon in the second half of the year. There's a clear support for taking the deposit rate back to zero and into positive territory by early next year. At the same time, you have dovish policymakers who've been very clear that they're worried about at least a technical recession, if not a worse outcome. And, the challenges are very severe. The impact of high commodity prices is very much so far an externally driven inflation in the euro area. So we have core inflation at 3%. Now that's well above 2%, but it's still comfortably lower than we're seeing for core inflation in the US. At the same time, we're starting to get some signs of a real downturn in sentiment. The German IFO index was particularly weak. Expectations are deteriorating, and we haven't particularly had any signs of wages really picking up. Again, that's a contrast with what we see in the UK and what we see in the US, where there has been an acceleration in wages, and perhaps where policymakers may be a little bit more justified in worrying about inflation becoming embedded in this wage price spiral. So far in the euro area, that's just not the case.
Sarah, which of these economies, US, Europe, US, Eurozone and UK, which of them will enter recession first and when?
To be honest, we're not forecasting recession for anywhere, but we do have very weak growth outcomes, actually for the US in particular. But I think that the euro area, some countries in the euro area are vulnerable. The big question is, does Europe embargo Russian oil and gas, because that's a game changer. In the event that oil, particularly if gas, is cut off, then we can clearly see that we would have Germany in recession, Italy would struggle. Now, policymakers are not planning to go that route, although they are as rapidly as possible withdrawing from the Russian energy market. But I think that's where the big risk lies. In the US, just briefly, the run-up that we saw in stock building in the last part of last year does carry some big risks for first quarter growth, possibly for first half growth.